In this example, we are looking at the year-end accrual of bond interest. Basically, we're looking at an adjusting entry for the bond interest. So we have a company that issued $1 million of 7% bonds on October 1st at 96, so they're issued at a discount. The bonds are dated October 1st and pay interest semi-annually. The market rate is 8%, and the fiscal year ends on December 31st. So we are going to prepare the journal entries to record the issuance of the bonds, the accrual of the interest, and the first semi-annual interest payment date for April 1st. And we're going to use the effective interest method for the bond discount and bond expense. So the first thing we're going to do is we're going to record the issuance of the bond. So this is something we've had quite a bit of practice on. We debit cash for 96% of the issue amount. So that's $960,000, and then the bonds payable amount is always for the face value amount. So that leaves us with $40,000 debit to our unamortized bond discount account. Then we're going to do the accrual of interest. So when we talk about the accrual of interest, it means that on December 31st there has been interest that has accrued, but it's not being paid out yet. So we have to do an adjusting entry for the amount that has accrued. So what we're going to do, you'll notice that it's similar to when we pay the interest, only we're using the bond interest payable account because we're not paying the interest. We're calculating the amount that has accrued and will be paid later. So we take our carrying value, which is $960,000 because we issued it at a discount, times our market rate, times 3/12, because if you look at the dates, 3 months is the amount that we're looking at. And that gives us $19,200 to the bond interest expense. Then we're going to look at the amount for unamortized bond discount. So the amount of unamortized bond discount is going to be the difference between bond interest expense and bond interest payable. Bond interest payable is calculated like we do cash. Face value times our face rate times our time, which in this case is 3 months out of 12. So the bond interest payable is $17,150, but since our interest expense is based on the 8% in the carrying value, the difference, the amount that's going to be credited to unamortized bond discount, will be $1,700. Then we're going to look at the first semi-annual interest payment. So the semi-annual interest payment is going to occur on April 1st. So we had October to December is where our 3 months came into play, and now we have an actual payment date of April 1st. So we calculate cash like we have in the past, and cash is going to be the face value times the face rate times 6/12 because we pay interest every 6 months, and that's the $35,000. Then bond interest expense, we're going to calculate it for the remaining 3 months, January 1st to April 1st. So just like we did up here for the 3 months, we take our carrying value times the rate times the 3 months, gives us the $19,200. Bond interest payable, that's going to come from December 31st adjusting entry, since we're paying the full $35,000 out now. $19,200 of it belongs to 2015 for the expense, and the $17,500 belonged to 2014 for the expense, and that's where the payable amount comes from. And then we also have to calculate the unamortized bond discount amount, which this $1,700 was for 3 months and it belonged to 2014. So now we're going to calculate the remaining 3 months, which just happens to be the same. So basically what we did is we took it and split it in half. Half the bond interest expense went to 2014 and the other half went to 2015, and then half the discount went to 2014 and the other half of the discount went to 2015. But in light of the matching rule, just like the adjusting entries we've done in previous classes, we have to make sure that the expenses get recorded in the accounting period in which they were incurred, which is the whole purpose of this adjusting entry here on December 31st.